Hi, Mike Swanson here. I sent you an article a couple days ago telling you that I was now becoming bullish on the stock market. Now, what I want to show you today is why I feel very confident about this and why you should too. Because I've gotten a lot of emails from people that are skeptical or worried that the stock market's not going higher, or they just want more evidence for it. So what I want to show you is to explain this is why I got bearish in the stock market in 2007 and was very confident in calling a bear market. Now this is a chart here, the S&P 500. This is the 150, and this is the 200-day moving averages, and these two red lines are the 200-day Bollinger Bands. Now I talk about 200-day averages a lot, and it's a common indicator that people use, but people don't really feel confident, I know, a lot of times about relying on it. Well, in 2007, the stock market moving averages started to flatten out, and one thing I said then is that when the market stays below it for more than 6 weeks, that's a sign that we're actually entering a new bear market. And this is the opposite of what's happened last week. Of course, we're above that moving average for 6 weeks. But more importantly than that, though, is that if you go beyond what you're just seeing in the major market averages and look at the individual sectors, you see a very even more powerful indicator. For instance, in 2007, at this time, a lot of people we're thinking, oh, this is just a correction, don't worry about it. We've seen the market go below the moving average before. Don't get out, you might miss out on further gains. Well, if you looked at the sectors that make up the stock market, you would have seen clearly that the stocks themselves and the sectors themselves were acting worse than the stock market. And if you flip this around to today, you actually see the opposite situation. That's why I'm very excited now about the potential for the stock market going forward. But I just want to show you real quickly the situation in 2007 and why, if you would have looked at the sectors themselves, you would have known for sure that the stock market was in deep danger. I'm just going to go through them real quick. For instance, these are mortgage stocks. Bam, they're crashing while the S&P 500 didn't look so bad to most people. Insurance stocks, construction stocks, hobby stores. Look, I mean, the bear market for these sectors actually started in May and we're in full force in December. Boom, savings and loans, semiconductor stocks, office supplies, credit services, banks, building materials, home improvement stores, department stores, specialty retailers, REITs, airline stocks, circuit board stocks, REITs. Notice how bad these sectors were doing and how they'd all topped out almost a year before the stock market was clearly in a bear market. Hotels, closed-end funds, more banks, sporting goods stores, more banks, home furnishing stores, music stores, vehicles, investment brokers, specialty eateries, general entertainment, hospitals, lodging. See how these sectors were just getting totally annihilated while most people were still being bullish on the stock market. And what this meant was that most stocks, most sectors had been well advanced into in bear markets way before it became clear that our stock market was. Now, let's look forward to today and see what's going on, because you're going to see a very interesting story right now. Now I'm going to sort these sectors real quickly by the top gaining sectors, but actually the gainers aren't what really interests me right now. Because what happened on the rally, a lot of the bad sectors I don't really think you should really get involved in now, actually gained the most in the March to May period, because initially the rally was fueled by short cutting. For instance, these are banks that were the top gaining stocks, and these sectors still don't really look that good for the long term, and I personally don't have any interest in messing around with them. But this is where things start to get interesting, is that here you have the retail sector, the REIT retail sector. And what I'm saying is that a lot of sectors in the stock market are basing right now. They hit the moving averages and they're just going sideways. But more importantly, the 200-day Bollinger Bands are coming together. That means the volatility in these sectors is shrinking, and they're going to be poised to make another move probably sometime in August or the first half of September. And the way the patterns are forming, it looks like this move's probably going to be to the upside. And that means it's going to be a quick jump. For instance, the 200-day Bollinger Bands in here are going to come together, and I can easily see this retail sector jumping up to 300 or something, which would mean another surge for the market averages. The key, though, is that the vast majority of sectors in the stock market now are forming patterns like this that you're seeing right here. They may not have jumped up as strongly as the S&P 500 did in the March to May time frame, but they're consolidating and going sideways and getting into a position where they're most likely going to make a big move sometime within the next 6 weeks. And that move is going to be to the upside, most likely. You're simply seeing the opposite situation that you saw in 2007 in the fourth quarter, where most sectors were clearly in bear markets, way ahead of the market averages. The market averages simply followed the rest of the stock market down and caused a stock market slaughterhouse that really hurt people all the way up from that time period to March. And now the opposite is happening, where we saw a bottom in the market averages. We saw a nice punch up basically from March to June. We saw a pullback, and now we're making new highs in the market average. But what's really significant is that first rally from March to June time period was really led by select issues in highly shorted sectors in the stock market, such as the banking and financial sector in particular. But now leadership in the stock market is shifting away from those sectors broadly into the vast majority of sectors in the stock market to create a truly healthy advance in the market. And that's why right now I feel very confident to make calls and statements like I did the other day that the stock market is in a bull market. Now I'll go through some of these sectors real quickly so you can see the proof for yourself. Here's the railroad sector, broke out, consolidating. Notice, well, here's one doesn't look as good, but still consolidating even though it's below the moving average. Water utilities, aerospace. Notice all these sectors above the moving averages, and they're consolidating. Insurance brokers look like it broke out today. Healthcare, information technology, food wholesale. This one doesn't look as good, but that's okay. Here's one that does. Regional banks. That one doesn't look as great. Accident insurance looks interesting. This one actually looks real interesting, consolidating right there. I mean, it's sector after sector. Manufactured housing, conglomerates, transportation, air delivery. Another one, the publishing sector had a nice pop the other week, consolidating. Food. But look at the long term. In these sectors, property, general building, personal products, telecom. That's a sector I like a lot. I just bought several telecom stocks in the past week and a half. One's paying like a 10% dividend. The other one's like 12% right now. Discount stores, healthcare, personal services, beverages, small tools. But you get the idea here. I mean, I can go through these quickly. It'd take me an hour to go through all of them. But just look at this. Look how positive these things are looking right now. And when you see positive developments inside the sectors that make up the stock market, you got to become more positive in the stock market. That's exactly what I've done. Just as I became a pound on the table bear in the fourth quarter of 2007, warning and begging people to get out of the stock market. Now I'm saying the sectors are looking positive, and it's a good time. Now, what do you do to make money? In 2007, I was saying get out if you want to make money short. And I know it's tough for people to make money shorting stocks and shorting ETFs and bear markets because it goes against your mentality. And I spent a long time preaching that, and that's how I basically made money. And I abandoned that strategy a couple weeks ago. And now I believe the best money to be making in the stock market is individual stocks, not in ETFs, not in mutual funds, which basically are going to track the performance of the market. And it's tough to get a good entry point in the stock market when you're so far off the March lows. Where would you put a stop in ETF and be able to not worry about things? Tough to do, and the return isn't as good. But when it comes to individual stocks, you just got to do the homework, and you spend, and I'm doing it. I'm spending, probably 8 hours, 10 hours a week just looking through stock charts to make lists of stocks that I'm watching to do further research on, narrowing down the entire universe of the stock market just to a manageable list that I can keep an eye on, that I can look for entry points to put more money in and build a portfolio. And you can get stocks that you can risk 5 to 10% on and stand and make 30%, 50%, in some cases even 100% in fast-growing small-cap stocks. And this is when the stock market becomes fun. I mean, I made a lot of money last year, but it's a struggle to make money shorting stocks. And it's tough to help people doing that because most people aren't interested. Even in bear markets, they just can't do what's right. It goes against the grain of everything you're told on television. But now, most people always want to be bullish, and now it's actually paying off to be bullish. But you can make big money by doing the homework in individual stocks. So I hope, if anything, that you've gotten some confidence about the stock market from watching this presentation, and don't have to be so fearful and doubtful about the market rally. Look, I don't really give a crap anymore about the market averages because I'm not trading them. And as long as the overall stock market environment is positive, which this analysis of the individual sectors that make up the market suggests it is, you don't have to worry about the market averages to make money. You just look for stocks as they line up, as they get into position, so they look like they're going to go higher. You take your entry points, take your positions, and you benefit from it. And you manage your risk as always, and you go on from there. And I'll be talking to you later.